Like all central banks, Bank of England also was moving towards higher interest rates to bring down inflation. Bank of England had printed over £475 billion over 2 years from 2020 and bought bonds in the open market to support fiscal deficit during the COVID years. They had a plan now to sell those bonds and suck out the liquidity from October 31st, 2022. Now, UK gilts had moved up in 2022 because of this news, but only as much as US Treasury yields went up. What went wrong in the UK? Well, the United Kingdom Finance Minister unexpectedly announced huge tax cuts to stimulate the economy. Given the large energy subsidies, this tax cut meant a much larger budget deficit, which meant the government would issue even more bonds. Bond yields in the market shot up from 3.5% to 4.5% in just 4 days following the tax cut announcement. Now, because of this swift upward movement in yields, there was an unexpected victim: defined benefit pension funds. Defined benefit pension funds have to make sure that their assets like stocks and bonds can generate enough money to meet liabilities, which is monthly payout that has been guaranteed to the pensioners. But due to abysmally low level of yields, zero interest rates over the past decade or so, pension funds became increasingly underfunded. That is, the return on their investments were lower than the liabilities which they have to pay because of the defined benefit plans. Due to this, pension funds increasingly moved towards aggressive, risky LDI strategies involving derivatives to generate more returns in order to reduce the deficit. Now, what is LDI? It means liability-driven investing. Now, the most popular LDI strategies are total return swaps. Now, just tell you, this LDI works like any swap. The pension fund buys the swap, that is, it agrees to receive fixed returns and pay variable rates. On the other side, could be a bank or a fund which is getting fixed interest from its borrowers but needs to pay variable rates on its source of funds. So it sells the swap which the pension fund is buying. Now, when the variable rate rises sharply, which happened when Bank of England raised rates, then the market value of the swap falls and the pension fund has to fill the gap with cash. Until last year, the rates were falling, so the price of the swap was rising and the funds were paid money. But now, with the sharp rise in rates, the swap price fell too sharply too soon, forcing the funds to sell their bonds to provide the cash. This is what happened in the UK. Yields went up by 360 basis points on the 30-year bond in just a few days or weeks. So funds had to bring in cash, they had to sell bonds, bond prices fell even further and the yields rose even more. What went wrong in the UK bond market is some pension funds had protected themselves by another route, that is leveraging. They pledged their kitty of, say, £1 million of bonds to take a loan. Now, banks, when they give a loan, take a margin of, say, 20% and give them, say, £800,000 as loan. With this, the pension fund buys more bonds and again collateralize them to buy 80% of 800,000. In short, they levered up 4x or 5x. The agreement, the condition is, when the bond prices fall sharply, they have to provide cash to top up the value of the collateral bonds. Here again, the sharp fall in bond prices led to manic bond selling to provide that top up, leading to further fall in bond prices and rise in yields. The Bank of England helped. It stepped in to buy bonds and help the pension funds to get time to arrange the cash. But yields rose again when Bank of England said it would stop buying. It is possible the yields will stop rising only if there is a substantial good news, improvement in sentiment, which means either the government announces it won't borrow much, it will not proceed with so many tax cuts, or the Bank of England says it is cancelling the bond sale plan. Okay. Now, will this malaise spread to other countries? Yields did rise in Europe, US, and Australia, partly because poor sentiment. Who knows where there may be unknown leverage. Also, British pension funds did sell some of their small holdings of overseas bonds. So, yields have gone up in US and Europe and Australia too because of the United Kingdom problem. But the moral of the story for all central bankers is they can't keep on only attacking inflation, they have to worry about financial instability.